Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, something extremely bearish happened in the markets today. We're going to tell you about it, why it's such a powerful sell signal. You're not going to want to miss this, so let's dive in.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
So Bob, we got a super bearish signal in the market. And I think before we get into what that is and show how that usually reacts in terms of how the market performs going forward over the next few days and weeks, it really, I think, is confirming the structural problems in this economy.
Yeah, and first of all, hey guys, sorry about yesterday. It was Fed Day. Phil and I, our schedules diverged, so apologize. No vid yesterday. But yeah, so Phil, guys, stay to the end because this is wild. It'll make you a lot of money. We just been piling on this stuff with you guys for weeks and weeks and weeks on the macroeconomic. Well, things are coming to a head now. This thing with yellow freight, you can't discount this. This is real-time macro. They don't have enough business for their loads, Phil, and this company's going under. I think 30,000 truckers can lose their jobs. This is going to be a liquidation, guys. This isn't going to be a reorg, okay? Because there's so much excess capacity in the truck freight environment right now that they don't even need yellow freight out there. Companies haven't been using them, and so they're gone. And that's not the only one, Phil. You want to throw up this next chart? This is pretty wild. This is one I threw to you earlier today, because Apple is the largest company in the indexes, okay? As Apple goes, the market goes. And everybody is singing Apple, 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 but now we have a situation here where one thing we didn't put up on a chart, the phone sales, the the upgrade cycle has elongated on the upgrades. So people aren't upgrading their phones. Okay, that's number one, bad news for Apple. Number two is their MacBook sales are cut in half. So if Apple disappoints or misses in this go around, it could be thunderous for the markets. Yep. But while we throw one that's near and dear to people who have teenage kids or preteens, I should say, Disney World and Disneyland and Disney are imploding.
Yep.
The movies aren't making any money anymore. I live out by Disneyland, where they're just advertising like crazy to get the locals to come in with deals. And Disney World, you're more familiar with it than I am. You've attended there with your family quite a bit in the past, and so you have a kind of a better read on that. But I imagine, Phil, that the whole park is running at excess capacity in the summertime, which is pretty insane.
Yeah, I'll speak a little bit to that. Disney World during this time, and I've heard excuses like, oh, it's been too humid in Florida. No, you know what? It's always humid at this time of year in Florida. It's not a weather problem. This is a tourism problem. And it's, I think, symptomatic of what we're seeing across the board. Look, I'm over, in Hawaii, and we're seeing it also here too. Year over year, car rentals are down, right? So there's a fundamental problem with the consumer here. But Disney World is a huge indicator, because I remember specifically when it was 08, 09, Disney World was not busy because that big downturn, nobody was spending money, right? And it's the same situation, I feel. I think this is a bigger leading indicator. I look at this. I think Apple sales are a huge leading indicator. And the other one I look at too is what's going on in the Vegas convention circuit. Vegas is a big recreational area. I know from my contacts there that, businesses aren't doing well there. But the convention circuit is really the one you want to see. That, when we had the last problem we had was COVID, and that crashed, that convention circuit crashed, and then it came surging back. Well, this is what we're waiting for next. I think once you start to see the corporations pulling back on their spending significantly, I think then you really know we're in the clutches of a recession. But Disney World this time of year being this empty is, I can't emphasize to you enough how extremely rare that is. This should be a giant red flag that we got a real problem with this economy.
Yeah, and Phil, my wife, the business that my wife owns is she caters to towards the affluent traveler, and her business is down 30% from Easter on a go-forward basis.
I believe it. Yeah.
And so that's when people tell me, that, hey, things are okay. I'm like, well, we see it and we live it every day. So
right.
That's why I'm always shocked what Airbnb's doing. Although that stock broke today, so we'll see if that's going to be a good short trade. But Phil, hey, you know this one better than I do. Do you want to speak to this next chart?
Yeah. So then, okay, it's like the consumer's not doing well. Well, what about the businesses and the larger economy? If you take a look at this chart here, all of these are telling us that we're going into a recession. We have a couple of charts stacked on top of each other. The top one is bond default rates. You should not see this really upticking, and whenever it does uptick, there's usually some structural problems going on. And the only time that we've really had this go up without triggering a recession was in the 2016-2017 time period. But I think if you couple that with what's going on below with the leveraged loan default rate, okay, now that's ticking up to levels that are starting to get into what would trigger a recession. We're not quite there yet, but I think with everything going on, I think you have to look at when these things start to uptick and then they get to this level where they start to expand. So we'll keep tabs on these levels, but we're very close to an expansion here, and that's going to guarantee a recession if we do get it. So they're definitely waving a warning flag here for markets. And then, Bob, the other one that was really interesting, I thought we can speak on this one, is the M2 money supply. It's not the supply in the system that's still very high, and that's why we still have things sloshing around and the markets are able to kind of have these rallies that we're seeing, but it's the annual average change that matters. That means the Fed is doing what they were set out to do, and that is to remove all the excess M2 out of the system that was injected from COVID. Look at these levels now that we're getting into historically, right? I mean, when we go negative M2 supply, and if you guys aren't familiar with what M2 is, that is the measure of money in the system. This is money in checking accounts, money in savings accounts, money that institutions own. Okay, it's a broad measure of the circulating dollars in the system. Technically not dollars, they're Federal Reserve notes, but you know what I mean. But look at when we go negative, this, if starting over there in 1876, right? This is stuff that historically matters a lot. Encompasses part of the long depression back then. Then you have the panic of 1893 to 96, right? Then you have the panic of 1907 and the depression of 1920-21. And then you obviously have the Great Depression. But you'll notice every one of those time periods had negative M2 growth. So you're sitting here going, hey, we're going into a new bull market. That's the general consensus here because we've gone up and we're approaching these all-time highs. And the M2 supply is going like, wait a second, that's never happened in the history of M2. So I think like we've been seeing, Bob, and what's been weird about this move, and you've heard from other professionals saying like there's a lot of weird outliers in this move up that are bucking or deviating from things that should matter. And this is, I think, a big one here.
Yeah, I mean, this is the one that kind of made me sit up. Look, we may be talking macro bearish stuff, but last thing that Phil and I want to ever see happen is to have the economic environment match what's happening with the M2 growth. Okay, so if they don't start balancing this thing out anytime soon, we're going to find ourselves in a world of hurt. So I'm pretty bummed out about this one. But look at this on the heels of that, Phil. Look the company's done. People don't realize that so many companies like Apple, what they've done is that they borrowed so much money to buy back shares, and especially the multinationals, they piled a bunch of cash overseas in lower tax environments. The money's essentially trapped overseas. So in the U.S., they've taken all this debt, to manage their businesses or to buy back shares. And since Powell has been doing his rate raising, he finally got that annual interest expense has doubled, Phil, and it's going to double again as we go through. I think there's $5 trillion of debt that's going to be refinanced over the next 18 months. I mean, it's a mind-boggling amount of money. It's going to absolutely crush cash flow. And I read something else, didn't have time to throw it in here. Inflation's going to keep moving up higher because it's going to always go ahead of the wage growth, because that's another way in which Jerome Powell is going to suck out what they call this excess demand that they're seeing with the slush fund fill. And and we're already seeing it. So if you're in an environment where you sell sell something that's nice to have or a service that's nice to have, your business is likely to implode over the next 2 to 3 years. And only businesses that are selling services and products that you have to have, that you have no choice, i.e. a plumber, things like that, where you have no choice but to spend the money, is that you're going to see a major shift towards that versus the nice to have things. So that's what I see coming with this, Phil. It's going to really start to sink our teeth into this thing over the next 18 months. That's why this recession that's coming is not going to be a V. It's going to be an L.
Yeah, I agree. And it's deja vu again, right? Because last 2 times we had them hiking, they were hiking into bubbles. And it's exactly the same setup here. We're hiking into a bubble. The only difference is we're not at all-time highs. We're at a lower high here. So again, you know, people will say, well, that's all great, you know, and there's plenty of evidence for problems in the economy. When does it matter to the market? So that's going to bring us to our next chart here. And we're just going to look at a live chart. This is the SPX S&P 500. This is just the index. This isn't the futures. And the reason why we want to hone in on this is because we have a bearish engulfing candle here. These are rare in the SPX because of just the nature of the SPX. It's rare because and this is a true engulfing candle. Now, in this day and age where we have crypto that trades 24/7, you don't get these because you lack an overnight session or you lack a weekend session where there's no trading, right? Crypto runs 24/7. Well, in the traditional markets, you can gap up or you can gap down. The most bearish candle I think that you can possibly get is a gap up and then fully engulf the previous day candle and you close below that yellow line, which is the previous day's low. That's a true textbook bearish engulfing candle, and it's on the daily, which daily and weekly, when you get these, are extremely bearish. We'll have to see how tomorrow closes. We may possibly get one on the weekly as well. But the point of the matter is these are rare and they are powerful. So let's zoom out and take a look at the times where we've got bearish engulfing candles at or near highs. And I highlighted those with these red lines here. So this last one came in at April 2022, and we proceeded to dump down several hundred points. I think when the bearish engulfing actually closed, we were up near 4,400, and ultimately we saw a low before a big bounce down to 3,600 and change. All right, so that's a huge amount of points right there. And then ultimately we made a lower low off of that. Before that was right before the market highs. We had a bearish engulfing November 2021 near the highs. So this one had a dip. So the bottom line is this: you're going to get a dip. It's just going to be a matter of how much and how long. Is it a cycle top or is it a dip near a larger cycle top where we may go up and test the highs one more time before really rolling over? We don't know, but what we do know, how to gauge the drop. So typically you will see us go to the bottom of the linear regression channel, which if we were to do that here, let's just say this rolls over and the linear regression channel is going to travel up a little bit, we're probably going to end up somewhere in the vicinity of, 4,200 to 4,300, depending where it meets up. We have a gap. The gap below here at 44.45 approximately. That's that's another 100 points lower. High probability off of this candle to get that. Whenever you get this engulfing candle, a lot of times they will not retrace much. If you get a retracement halfway up this candle, all right, and just eyeballing that, let's just say it's around 45.70 or so. That's typically a big spot where the sellers will come in and whack it back down. These candles with almost 100% probability see multiple days of downside. So I can't stress enough, how bearish that candle is. And they don't happen very often, as you can see with the red lines. We'll go years without seeing them sometimes. And just to kind of give you guys a little more reference here, going farther back in time, you can see back in 2019 and back in this era here, we had a few that fired. This is a very bullish time in the market, but even then we saw here, you came down, you had about 4 or 5 days down to the inner linear regression band. You saw here, we went all the way down to basically the bottom of the linear regression band. Here again, poked outside the linear regression band, and that's typically the response we like to see, is we travel to the other side of the linear regression band. Here we got one that went to the middle of the linear regression band. So again, you're going to see multiple days down usually with follow through here. And so how we react with the linear regression really tells us if we're going to start seeing a little bit of downside and then another push up, or a lot of bit of downside. I think, if we get to the middle of the band and we bounce, that's potentially a spot where maybe that's all we get. Otherwise, if that fails, we go to the bottom of the band. And then where things really get interesting is if we start cracking through the bottom of the band, you actually see the band rolling over, similar to what we saw back in the beginning of 2022. Then you start riding the lower part of the band. Then you really know that you have a larger move on your hands. band, and you'll get retracements into the upper part of the band with this darker blue shading is that inner part of the band, which usually serves as really strong rejection points. Once you start to claim into the upper part of the band, then you start looking at, okay, maybe that particular part of the move is over and you're going to retrace higher. So it's an easy way to look at the move. You can get this with the Trader's Toolkit and along with the Kona and the other sniper signals and the heat, and that's a great package. Gives you really strong signals applicable to all time frames. We're just looking at the daily here because this is an extremely powerful signal here, Bob.
Yeah, I mean, I woke up this morning, I was going to take a mental health day because they gapped this thing up, and I'm saying, oh my gosh, I mean, when's
Groundhog Day.
Enough? What's
Right.
that?
The Groundhog Day.
And then all of a sudden, this started at 11:30. We started watching the derivatives. Put buying came in, and then, I think it's important. Maybe we could speak to some of the reasoning here too. So, at 10 o'clock this morning or 1 o'clock Eastern time, the Japanese government came out and said that they were going to let their maybe their band float higher on their 10-year yield. They've been suppressing their yields, called yield curve control, so that their debt holders don't get overwhelmed with interest payments, and they're going to let that rise. Japan's one of the last countries that basically flood the world with liquidity, and when they do that, a lot of that finds its way into the stock market. And when they pull this thing back, it's like a rug pull, and that happened. Also today, they voted on Basel III, which is basically a tightening of credit and more reserves for banks worldwide. So that came into position today as well. And then, also, too, what people don't realize is that whatever this glide was from Friday, we're in an environment where there's what they call the window of weakness, where there aren't enough calls to support the derivatives higher. And as the market rolls over, it forces people who sold puts to buy them back. And so that's why my view is, Phil, I think, and maybe you could speak to the what they call the vol trigger and some of these other triggers that would force what we call accelerated selling.
Yeah, I have a chart up here of the Japanese bonds that's over here on the left. And, at first they were trying to cap it at 0.25%. But if you can look over on the right, what did that do to the yen? Just decimated the yen. And the yen's heading for new lows, and they know it. And the Japanese consumer is hurting because they're facing inflationary pressures. They keep this up, and they're going to be dealing with hyperinflation. Japan's already on its deathbed. As far as the economy, the birth rate is in the toilet. They really can't afford to be unleashing hyperinflation. So they're going to relent again on the bond market. Now, that's significant for global markets because Japan is the last holdout on accommodating, right? This is like if the Fed was still performing QE like we were doing back in 2021 and the markets are just marching higher. So this has been like one of the last central banks that provided any kind of fuel for the markets and for leveraging up, things like that. So if the yen starts to climb back up, that's also going to be a headwind for global markets. And it's going to be interesting to see, where the Japan bond market goes, but it tells you that no one wants Japanese bonds. We were talking about that today in the room. Sometimes they're effectively buying all of their own issuance, which is like, okay, what's the point of having a bond market then, other than trying to keep the rates down for existing debt that's out there, right? But if you're just gobbling up debt you're issuing on your own, you're not really doing anything as far as debt goes, and so or at least bringing in income, but you are killing your currency, and so it's a huge problem here. And I think I think it's just one of a multi-headed hydra here that's just coming at any point will converge and it's going to matter really fast. I think the thing about the market drop today, Bob, is how swift it was. We shaved off a lot of points in a hurry, and that's typically how when a sell program comes in, an institutional sell program comes in, that's typically what you get. And we saw today, there's a, we can look at the ticks, which tells you like how many sell programs essentially are firing off. And I think, Bob, we saw all day long big negative tick prints, and we haven't seen that, and I would argue months. And today we got it all day long. And so to me, that tells me that institutions, when they're selling today, and you have to mark off this area on the chart as an area where we probably aren't going to push right up through. It's going to be an area of significance if we were to come back up and test it, if this isn't a cycle top and we are headed for lower into the rest of the year.
Yeah, I totally agree. I think that gap fill is in play. And look, and I think we have a date for at least short term 450 on SPY, 373 on the Qs. We'll probably hit those tomorrow, I would imagine. And then next week, probably run for that gap fill. And then we'll have to wait and see. If we break that swing low right below that gap fill, then we've changed the trajectory of the market short term. So people need to start paying attention now. You just can't keep piling up a lot of negative economic scenarios. Remember, Fed tax receipts are down, California tax receipts are down. So, we're essentially running recessionary. It's just that it's nominal, that you can't see it because we don't isolate inflation from the GDP. But I think, Phil, I think that's where we go right there.
100% agree. Let us know what you guys think in the comments below. Think we're crazy? Think this is a significant chance for a drop here? And how are you guys positioning? We'd love to hear from you. Other than that, Bob, I think that's all I got. And we'll see you guys on tomorrow's video. Thanks, Bob, for everything. We'll see you guys later.
Trade